The average 30-year mortgage rate in the United States has recently surged to over 7.8%, marking its highest point since December 1, 2000. This development has sparked concerns about the stability of the housing market, as what initially seemed like a minor inconvenience has now evolved into one of the most severe asset bubbles in financial history. The escalating situation prompts a critical examination of how the market arrived at this point, revealing alarming indicators for the future of the already precarious economy. The impending housing crash is predicted to be unprecedented, and to comprehend the magnitude of the crisis, a retrospective analysis is essential. Conventional charts depicting historical housing prices often overlook a crucial factor: inflation over extended periods, such as 40 or 50 years. Merely citing a home purchased for $300,000 in 2000 fails to account for the impact of inflation, adjusted for the current value in 2023. This amount translates to approximately $545,000. Therefore, apparent gains in home value may not accurately reflect real financial progress. To gauge the extent of the bubble, it is imperative to consider inflation adjustments and unveil the true escalation of home prices. To accurately gauge the magnitude of a housing bubble, it is imperative to account for inflation and reveal the authentic extent of home price increases. One effective tool for this purpose is the inflation-adjusted Case-Shiller Index. Rather than inundating you with tedious details, this index presents a clear depiction of real home prices, eliminating the deceptive impact of a depreciating dollar. The current economic landscape is fraught with risk, and the housing market is particularly vulnerable to a downturn. Homeowners and investors should be prepared for potential financial challenges in the near future. Your support for our channel is greatly appreciated, so please take a moment to like and subscribe. Now, let's delve even deeper into the intricate mechanics of the housing market and explore potential scenarios that might unfold in the coming months. As we navigate this complex scenario, it's essential to explore the intricate mechanics of the housing market and its susceptibility to external economic factors. Beyond the immediate concerns, we need to delve into the historical patterns and systemic issues that contribute to the fragility of the current housing market. Looking back at the aftermath of the 2008 housing bubble, the Federal Reserve's continuous efforts to suppress interest rates played a pivotal role in creating a new housing bubble. However, the real price of homes, when adjusted for inflation, saw a significant rise of 66%. This low interest rate environment has now led to an unsustainable situation where homes are priced exorbitantly, and there aren't enough buyers to sustain these inflated prices. The combination of rising inflation rates and the potential for an upcoming recession adds further complexity to the current predicament. It creates a perfect storm that could lead to a housing market crash, potentially worse than the one experienced in 2008. The analysis extends to the bond market, where the inverted yield curve emerges as a notable signal of an impending recession. Historically, every instance of an inverted yield curve since the late 1970s has been followed by a recession. This pattern held true in the early 1980s, early 1990s, early 2000s, 2008, and 2020. The current situation is particularly concerning as the inversion has deepened beyond previous instances. While the yield curve has recently started to move back towards positive territory, the most significant economic pain typically occurs after the inversion has completed and the curve crosses into positive territory. This was evident in 2008 when the recession began several years after the inversion. The Federal Reserve's endeavors to raise interest rates are facing challenges from the bond market, which essentially questions their strategy. The 30-year Treasury yield being nearly equal to the 10-year yield indicates investor expectations of persistent inflation. Investors favor the 10-year Treasury over the 30-year Treasury due to the uncertainty surrounding the future and the attractiveness of the 10-year yield. This suggests that investors believe inflation will remain high, potentially leading to the Fed reconsidering its rate hike strategy if inflation surges again. The housing market, being particularly vulnerable to interest rates, is at risk of a crash due to the combination of rising rates and an uncertain economic outlook. Homeowners with adjustable-rate mortgages or those seeking refinancing will face higher monthly payments due to rising interest rates. This could lead to an increase in foreclosures and a surge of homes available at discounted prices. Investors who purchase properties with the expectation of continuous value appreciation will also face challenges as prices decline. They may end up owning properties worth less than their mortgages and experiencing reduced rental income. The current economic landscape is fraught with risk, and the housing market is particularly vulnerable to a downturn. Homeowners and investors should brace themselves for potential financial challenges in the near future. Your support for our channel is greatly appreciated, so please take a moment to like and subscribe. Now, let's delve even deeper into the intricate mechanics of the housing market and its susceptibility to external economic factors. The U.S. housing market has become increasingly expensive, with incomes needing to rise by over 50% to make buying a home affordable. There are three potential factors that could make housing more affordable: rising incomes, increased inventory of homes for sale, or lower mortgage rates. However, there are challenges associated with each of these options. Income growth has slowed significantly in recent months, making a drastic jump in incomes unlikely. Additionally, homeowners are hesitant to sell their homes due to low mortgage rates, reducing the available inventory of homes for sale. Builders are also less confident about building new homes due to concerns about rising mortgage rates and the overall economy. Finally, while lower mortgage rates could make housing more affordable, the Federal Reserve is unlikely to cut interest rates in the near future. Given these challenges, patience is key for potential home buyers, investors, and homeowners. The housing market is cyclical, and things will eventually change. It is important to be financially educated and understand the factors that affect the housing market in order to make informed decisions. Here are three key factors to pay attention to. The impacts of higher interest rates. Higher interest rates can lead to a cooldown in the economy, potentially increasing unemployment. The cost of student loan repayments. The resumption of student loan repayments could impact the finances of a significant portion of the population. The debt bubble. The overall debt bubble in the economy is a cause for concern, as it could lead to financial instability. In light of these concerning developments in the housing market, do you have insights or differing opinions? Share your views below, and let's engage in a conversation about the challenges and opportunities ahead. Your input contributes to a more nuanced discussion, and we appreciate your participation in shaping the dialogue around this critical issue. If you're curious about power of stocks, Tesla stock versus Bitcoin, check out the informative video by clicking on the provided link.